these 4 stocks are down significantly year to date and could represent a good buying opportunity. Let me know in the comments below if you've been buying any of these stocks for your own portfolio this year as they've been falling. If you watch this channel and you like the content that I'm making, please do consider subscribing if you haven't already. It's absolutely free to do, and of course it does help push this channel to more people. And if you decide to in the future, which I hope you don't, but you can always unsubscribe. Right now, YouTube is telling me that 81.1% of people that watch my videos don't actually subscribe to the channel. We're going to go through these stocks in the most logical order, from the stock that has been sold off over the past year to date the least, to the one that has been sold off the most year to date, which is one that's down by about 40%. So absolutely crazy sell off there, but we'll get to that one further on in the video. And as always, this video is not financial advice. Nothing I say is to be taken as financial advice. Please just take this as entertainment. You know, if you like any of these stocks, go and do your own research and do thorough research before you decide to add any of them to your portfolio. The first stock is one that is behind a company that is a global household name. I would say with certainty that everybody watching this video knows about this company and has been a customer at some point of this company. And if you haven't been, congratulations to you. You are way healthier than I am. But it is the biggest fast food chain in the entire world. Doesn't need an introduction, it is of course McDonald's. Now you don't need me to tell you that McDonald's is a wonderful business. You know, clearly it is. They have been doing amazingly for decades upon decades, way outperforming the index over that time period. But something about McDonald's that not everybody actually knows is that they actually operate a very smart business model. They have a franchise model. Some people think that McDonald's is simply a food and drink business. You know, they operate to sell food and drink, but actually, they are way more than that. And they are much more of a real estate business than they are a fast food business. Now, I do recommend, if you've got some time and you like watching stuff like this, to go and search for a series or a documentary. It's on Netflix, I believe. It's called The Founder. And it basically depicts the creation of McDonald's. And it's really interesting. So go and watch that and you'll learn loads. While the franchisees run the restaurants and handle the day-to-day operations of the McDonald's stores, the McDonald's Corporation actually own the land and the buildings. This is why I'm saying they're more of a real estate company than they are anything else. So the franchisees actually pay rent and royalties to McDonald's Corporation, which then takes up a lot. It makes up a significant revenue stream for McDonald's. And in fact, they actually only operate about 5% of their own restaurants. And you'll already know that you're never far away from a McDonald's. Like wherever you go in the world, there is always one in a pretty close proximity. But despite already having this enormous global footprint, McDonald's expects to actually be able to keep growing the number of restaurants, their restaurant count, by about 4 to 5% annually moving forward, which to me is quite impressive because how many more McDonald's stores do we actually need? I don't know. I quite like their McFlurries, I won't lie, but the world is moving to a very unhealthy place, a very convenience-driven world. Is McDonald's really helping that? I don't know. But we're not here to talk about the ethics and the morals of McDonald's. We're here to talk about an investment opportunity. So let's move on. They have a very healthy cash flow, and this is particularly important because McDonald's are a dividend stock. So its payout is ultimately funded by their ability to generate cash. So just looking at the dividend page on Seeking Alpha, which by the way, if you want to try this platform for free for 7 days, and then if you like it, you can get 20% off, do use my link that I will leave in the description below. But anyway, we can see here, if we scroll down, that the dividend yield isn't the biggest. Like it's not the largest I've ever seen. However, what McDonald's have been able to do with their dividend, which is a very strong thing for dividend investors especially, is they've been able to grow their dividends consistently year on year for many years. And actually this is showing us 22 years, but this is capping it out and it's actually more like 47 years. They are truly one of those dividend aristocrat companies. And you can see here as well, they are paying a dividend 4 times a year. Something that they announced quite recently, a strategic move that they are going to be trying, is that they are going to be reintroducing a $5 Happy Meal starting June the 25th and running for a 1-month time period, I believe. And that is in an attempt to cater to their weakening consumer base that they noted during their first quarter earnings back in April. And it's clear a company like McDonald's is going to be somewhat affected by the macroeconomic situation. It's going to move up and it's going to move down, kind of in line with the macro situation. Having said that though, I've experienced firsthand that even when times are tough, people are still in their stores and are still queuing up to order their McDonald's meal. So, maybe people are either focusing on the wrong thing with their money, or it's a business that is going to do well no matter what happens. But let's now just take a look at what the stock has been doing this year, because it's not been doing all that well. So just quickly before we jump into the stock, we can see here that there are 3 ratings on Seeking Alpha. We've got a buy rating, a buy rating, and a hold rating. So, analysts are seeing the opportunity here, but of course you shouldn't always just go on what analysts say. Now let's compare it to the S&P 500 year to date. So what we can see is that this year so far, McDonald's stock is down by about 13% compared to the S&P 500 index, which is up by about 11.5%. And then if we zoom out to a 3-year period, we can actually see the cyclical nature, the ups and downs of the McDonald's stock. And we can see that right now they are moving downwards, whereas the index is moving up. If we zoom out to a 10-year period or even max out this graph here, you can start to see that actually McDonald's over a long period of time has done extremely well. But the question now that we have to ask ourselves is, will McDonald's recover again? And is this now a good buying opportunity? Let me know what you think in the comments below. The next stock that we need to speak about isn't a global household name like McDonald's is. However, it is a company that is operating in an industry, in a sector that is becoming somewhat of a household name, especially among investors. So this company is Zscaler. I don't really know how to say that. I'm going to say Zscaler like the Americans do. And this is a company operating in the tech space, specifically within the cloud security area. There are some great stocks in this sector, honestly. We've got CrowdStrike, for example, a very, very interesting, pretty strong company in my opinion. For each one of these cloud security type of companies, there's overlap for sure, of course, but they are all offering a slightly different thing. For example, CrowdStrike. They focus on endpoint detection and response, which is very, very different to what Zscaler are focusing and offering their customers. They are actually specializing in something that they call SASE. SASE. And this stands for Secure Access Service Edge. It's basically a fancy way of combining network security with secure access to applications no matter where you nor the application is located. Zscaler also emphasizes the concept of zero trust security, which means it doesn't automatically trust anyone inside or outside of the network. Instead, everybody must verify their identity and actually get permission to access each piece of the specific service or specific piece of data required. I would say, however, that lately investors are starting to get a little bit unimpressed, a little bit annoyed with the decline in revenue and their GAAP profitability status. However, could we be onto something here? Because of course the cybersecurity sector is in demand. It's in hot demand, and with the proliferation of AI, artificial intelligence, I really don't see that changing anytime soon. If anything, I see that ramping up as we move forward. And interestingly, right now, Zscaler has only actually captured such a small percentage of the market opportunity it has in front of it. Now, they have done pretty well in previous earnings. The majority of the time, I'd have to look through all the earnings previous, but I believe they've managed to beat top line and bottom line pretty much over their history consistently, maybe not every time, but the majority. However, they do have earnings coming up in a few days' time. It's the 28th that I'm making this video. They're coming out on the 30th, I believe. They may have already come out by the time you're watching this video, but we'll have to wait and see what they actually managed to achieve during that earnings, and especially what their future guidance is saying. So right now we actually have a very, very strong rating summary here. We have a strong buy and 2 buys. And then if we have a look actually to see what the growth rate is, revenue growth grade, is an A. It's very, very strong. Forward revenue growth is coming out as an A as well. So all looking good there. Obviously, I don't need to say this to you guys, but further research is of course required. So let's just have a look. Year to date, you can see down by a higher percentage than McDonald's, because that's the way we're moving through this video, down by 22.5%. Quite a significant drop over the course of this year so far, especially when you're comparing it to the S&P. And then if we zoom out a little bit, you can actually see that right now we are in a downward trajectory. Whereas, if we were filming this video back in February, it would be a very, very different picture. We'll zoom out now to a 5-year period. You can see they've had some very, very big success. It has been quite volatile though as well. 10-year, you can see that here too. The next stock up is one that I wasn't really planning to speak about too much in this video, just because it's one I've covered before a lot on this channel, and I cover it on my main channel in a lot more detail, so head over there if you want it. However, I do have to include it because it is one of the stocks that has performed pretty poorly year to date so far. It is one that I have as one of my largest positions, just to be fully transparent. Haven't guessed it already, it is of course Tesla. Now, Tesla stock has been relatively flat in terms of stock price for years now. It hasn't really moved very much. However, when you look at what the company has been doing, so you ignore the stock price and just look at what Tesla, the company, has achieved over the past few years, well, they have grown so much. They have achieved so much. So this is a perfect example of when the stock price and the intrinsic value of a company doesn't always align. I really don't see this company as a car company anymore. Of course, that is right now where they're getting the majority of their revenue from. I'm not denying that at all. However, I see this company as one of the most bullish artificial intelligence companies in the entire world right now. There are a lot of things happening in Tesla. On the 8th of the 8th, we have the Robotaxi event coming up, which is very exciting. I made a whole video on this on my main channel recently. I'll leave it linked somewhere on the screen now. So that will be really interesting. That could be very, very bullish. That could increase the stock price. We don't know. No one can predict what's going to happen. We do, of course, also have the revote happening for Elon's compensation plan and other things as well. The move to Texas, all these other things that we need to vote on. So if you are a shareholder and you haven't already voted, please look into that. But yeah, lots happening. Cybertruck release happened, it's ramping up, semi-truck, energy. What I'm trying to say is that this is a very, very interesting company, and there are many people that don't like this company, fine, whatever. But we can't deny that they are doing some of the most revolutionary, most needle-moving, is that even a phrase? I don't know, things in the market right now. ARK Invest, which is headed by Cathie Wood, which I'm sure you have heard of, have a price target for Tesla stock of $2,000 per share by 2027. And I believe right now they are actually updating their price target, so this could potentially even go higher. But the analysis of this was based on 2/3 of the enterprise value of Tesla being due to robotaxis. Elon responded to this saying it's possible, but very, very difficult. So he is seeing a pathway in which Tesla becomes a much bigger company in terms of market cap, in terms of value, than it is today, which I think it absolutely will. But he's not wrong there. What they are doing is some of the most difficult stuff in the market, and it is going to be very, very tough to achieve what they want to achieve. But if anyone's going to do it, in my opinion, it is Tesla. We've also recently had Nvidia's CEO come out and actually say that Tesla is ahead in terms of self-driving cars. I mean, I knew this anyway because I do a lot of research in this area, and it's very clear that Tesla are ahead. But to see such a prominent figure who has a lot of insight into this area come out and say that, it's very, very bullish. And he's also said that every car someday will have the ability to be autonomous, to not have a human driver in it. So it does seem, with everything going on, that we are moving towards a world in which transport will completely change, just like it did back in the day when we moved from horse and cart to ICE vehicles, internal combustion engine vehicles. The same thing's going to happen again, where we make a massive shift. It's uncomfortable, it's difficult, it takes time to move to that new thing, but it's going to happen, just like it did before. So much other stuff is, of course, going on in the world of Tesla. We could speak all day about it. If you want more information, follow my main channel. But let's now just take a look at what the stock has been doing. So year to date, down by basically 28%, which is quite substantial. When you compare this to the index, they've not been having a very good time at all. 1 year period down by 2%, not really moved at all. Like I was saying, 3 years, again, not really done anything substantial considering the growth that the company has had. However, if we move out to a 10-year period, we can see a very, very different story. And there has been time in Tesla's stock, the history of Tesla stock, that it has moved sideways, hasn't really done anything for a number of months, number of years before it really starts to ramp up on a significant catalyst taking off, or a few combined catalysts. Will that happen again? We of course don't know for sure, but it's a company I'm particularly bullish on anyway. Moving on now to the last stock on our list today, and it is one that is down by over 40% year to date. It has been a very, very volatile stock, and if you are an investor into this, congratulations for having a strong stomach and holding this through all the ups and downs. And unlike Tesla, this isn't one that I'm actually buying myself, but I do think it deserves a mention in today's video, and that is Lululemon. Lululemon makes athletic clothes for yoga, running, working out, and other things like that. You've probably heard of them. You know, they're a global company. I personally don't own any of their items. However, they do look very good quality. They are a little bit more pricey. They do sort of position themselves in that upper pricing market. But, you know, some people really, really swear by these products. They do have a very strong balance sheet with good margins, lots of money in cash, hardly anything, if not anything, in debt. You know, all round, it looks pretty good at first sight. And like I said, they do market themselves towards those high income shoppers, which has paid off for them pretty well, because what it's meant is that during times of economic downfall, when the average person can't really afford to be spending money on new gym wear, new yoga wear, the high income shoppers have still managed to purchase items, meaning the company has managed to power through even during difficult economic conditions. Lululemon is still expecting to double sales between 2021 and 2026, mainly driven by men's, international and e-commerce. And in 2021, the company came up with a growth framework that they called the Power of 3x2. So their Power of 3x2 strategy basically aims to double their 2021 revenue by 2026. And the growth plan is focusing on three main pillars: product innovation, guest experience, and market expansion. Key initiatives included in this plan involve doubling the size of its men's business, doubling the digital revenues, and quadrupling international revenues. And talking about international revenues, right now they are doing extremely well in the Chinese market. We do have earnings coming up in June, so we'll have to see again what the earnings are like, and more importantly, what the guidance is like moving forward to make maybe a more comprehensive judgment of this company. But let's take a look at what the stock's been doing, because like I said, it's not been doing very well. Year to date, down by a whopping 40.74%. So if you've done your research and you are convicted and you are bullish on this company and you've done your due diligence, you know, don't just throw a dart at a dartboard and pick a company. But if you've done that and this company fits your portfolio, fits your risk and everything like that, this could be quite a substantial buying opportunity. Down by nearly 41% in quite a short time period is very, very substantial. Let's just zoom out now to a 1 year period and you can see what's happened here. They've had a little rise and then they've fallen off the face of a cliff, which started back in March. Really, really, literally a downward jump there, which is quite shocking. Let's expand out to a 5 year period. Very, very different picture. Nearly meeting the index, but not quite. However, very, very volatile indeed. But they are one of those companies, and we had a few of these happen. We had Peloton, was it? And another few companies, maybe Zoom, that basically did very, very well during lockdown. They benefited immensely and their stock price went absolutely crazy. But since then, they've met pretty painful corrections. And we have to think about what the general outlook of the macroeconomic market is. And is consumer discretionary spending going to be impacted moving forward? Do let me know what you think about this company in the comments below. And are you buying now, or are you already an investor into Lululemon? There were many other stocks that I could have included in this video. So if there's anything that I've missed out that has had a very significant downward movement year to date so far that you think represents a good buying opportunity, do let me know what those are in the comments below. Don't forget, if you want to try Seeking Alpha, use my link. That will give you a 7-day free trial plus 20% off should you want to purchase it. It's a great platform. I use it all the time. Couldn't recommend it enough. But anyway, with all that said, as always, keep investing, keep analyzing, and don't forget to hit that subscribe button.